One of the other benefits beyond the obvious CFTC approval is an interesting sort of opposite side of the coin that we're discussing. Instant gratification is good for retail, but it's not what institutions want. What institutions want is a product where you can make or lose 10% of your money without making or losing 100% of your money. That is much more attuned to a hedge fund style investing.
This podcast is sponsored by Pragmatic Solutions, the player account management platform chosen by today's smart betting and gaming operators. Don't let technical constraints delay you from achieving your business goals. Expand your business, boost your margins, and dominate the market in any leading regulated jurisdiction with our powerful, flexible, and secure iGaming platform. Enjoy its extensive marketing tools, compliance protection, real-time data, and a wide portfolio of over 1,000 industry providers. It's time to upgrade your technology. Let Pragmatic Solutions show you the modern approach. Visit pragmatic.solutions and join the smart thinkers.
This podcast is brought to you by Pragmatic Play, a leading game developer providing player favorites to the most successful brands across the industry. With an award-winning multi-product portfolio of slots, live casino, bingo, virtual sports, and more, Pragmatic Play is powering up new possibilities of play through one single API. Visit pragmaticplay.com and discover your favorite every time.
And bingo, bango, bongo. The Christmas spirits are high here at the Vested Interest today. Benjie, Lloyd, great to have you guys with us. Lloyd, how are you?
I am great. Never better. Good to be here, guys.
Never better. Merry Christmas, my friend. Benjie, what about you?
I'm ready for the holidays, man. Let's do it. Let's go.
Yeah. I can see you're already in spirits with the skiing. Already started.
Yeah, I got the ski season underway last week, and hopefully we'll get some more in over the holidays. So ready for it.
Fantastic. Well, we'll keep the spirits high here throughout the time we have here together today. We'll jump straight into it today. We have a couple of really interesting topics here today. But first and foremost, we want to talk about the news that broke a couple of days ago that Robinhood are looking to potentially move into the US sports betting sector, which is a really interesting move by a company who is traditionally not from the industry that potentially could disrupt our industry. And the result of the news that came out a couple of days ago was a quick dip in the share price of the traditional regulated sports betting operators in the US. Now, speaking at the Robinhood's inaugural Investor Day then that happened at the 4th of December, the CEO of Robinhood, Vlad Tenev, highlighted the cultural and customer importance of the sports betting sector. And he said that we are keenly looking into that space. Nothing to announce just yet, but it's so important to our customers and in culture that we're excited about the sports betting opportunity, Tenev said. So, Benjie, perhaps jumping over to you first and foremost, what do you think about this potential move of Robinhood to enter the US sports betting sector? What's your analysis?
Well, I think the first key word there is potential, right? There's I'm sure a whole lot of conversations happening, but I don't think this is by any means a definitive endeavor that they're going to be moving into the space. I think it's something that they're looking at and evaluating closely, and for all the right reasons, right? They've got, first of all, Robinhood has been an innovator, and they've kind of recreated the industry that they're in, and they've kind of taken the old school style of investing, which is the long, kind of the Charles Schwab old school, long tail of earning 7 to 10% ROI annually, and flipped it on its head by targeting a new demographic that's a bit more TikTokified, and they brought in more of a gaming focused UI and UX and focus more on folks that are looking to buy and sell and make quick hits. And that plays into the mentality very much of today's sports bettor, right? You see the rise of SGPs and of parlay betting, and of course there are value bettors that are looking to grind out wins, but the masses seem to be looking for the grand slam or nothing type of bets, and to try and make big scores as opposed to something more steady Eddie. And of course, those are generalized statements, but when you look at the audience that Robinhood has, and you look at where the U.S. market is heading, and you look at where the TikTok generation is heading, and what sports betting is beginning to look like in the futuristic form, And one would surmise that if they were involved in this space, perhaps they would be better positioned to innovate and move quicker towards that North Star, whatever they define that North Star to be, than today's operator who's still using the tried and true sportsbook platform and is kind of gradually migrating towards what sports betting is going to evolve into. All that being said, if they want to get into the space, how do they do that? Are they going to go out and get licenses one at a time? That seems to be doable, and certainly a lot less expensive than it would have been a few years ago. But my best bet is that if they want to get into the space, they likely have to make an acquisition. And my best guess is the most likely target would be Rush Street. Do I think that all that will happen? Probably not. But those are some thinking points from my perspective.
It's interesting. Personally, I would be very surprised if Robinhood, either by way of M&A or by way of getting licensed themselves, went the route of competing with DraftKings and FanDuel with a fixed odds licensed sportsbook that pays state-by-state GGR fees and offers a relatively similar product. I just think the market is so mature already. The majority of sports betting prone customers on Robinhood probably have FanDuel and DraftKings accounts already. And it is so far outside of their area of expertise, of their core competency. It is a massive bandwidth drag to go through that process, whether by way of M&A or then maintaining those licenses while also maintaining your SEC compliance. My assumption would be, and look, I'm happy to be proven embarrassingly wrong on all of this, of course, would be that if Robinhood were to offer something in the realm of sports, either they have their eye towards some sort of federal program that's going to come out that's going to legislate sports betting on the federal level and obviate the need for the state-by-state regulation. Or more likely, I would assume, they would go the route that other groups have tried and are currently trying to go, which is going to the CFTC and getting a license for sports-based event contracts, similar to what Kalshi did for election-based event contracts. You certainly will probably have trouble replicating many of the instant gratification type bets offered, in particular in-game betting, micro betting, same-game parlays, because the CFTC has very specific rules that futures contracts cannot be a workaround for gambling, and they must provide genuine economic hedging utility and price discovering utility to the market. I think everyone would agree that there is very valid economic hedging utility in certain type of sports prediction contracts. The New York Yankees, when they make the playoffs, make a whole bunch of money selling beer and hot dogs during the playoffs. And so in theory, they might want to hedge their own risk, make a little bit of that hot dog and beer money in the case that they don't make the playoffs. But one of the then challenges with this is that in order to execute that type of contract, the Yankees would effectively have to be betting on themselves to lose in order to earn a payout when they fail to make the playoffs that makes up for the foregone hot dog and beer revenues. And most sports leagues will generally not be on board and see it as valid that teams should be able to effectively bet on themselves to lose in order to hedge economically. But you could think of others. There are advertisers and TV stations and sports bars and restaurants and hotels in certain cities who, if their team makes the Super Bowl, they'll triple their annual revenue. And if not, they'll miss their figures. And so my guess would be that if Robinhood were to offer, I think they would probably stop calling it sports betting and their lawyers would tell them to start calling it sports prediction contracts. But my guess is they would go more of a CFTC route, similar to a group called ErisX that made a proposal, which the CFTC commented on a few years ago. That group, ErisX, has now been acquired and is doing things in crypto futures. And there are a few other startups that we have been pitched on that are trying to pick up on their coattails. So I certainly think there is and continues to be interest in trying to follow a CFTC guideline designated path. And the last thing I'll comment is that people who know much more about this stuff than I do tell me that when ErisX, if I'm pronouncing that correctly, made their proposal for CFTC licensed sports futures and was rejected, that rejection comes with a comment from the CFTC, from the person who looked at the application. And again, what people who know this, I think better than I do, suggested to me was that the CFTC uses very specific language when they are rejecting a proposal but want someone to make improvements and amendments to it and come back with another proposal in the future. And my understanding, again, I can't verify this because I just don't have enough experience in this space, is that they have given some of those little buzzwords and keywords in some of their previous guidance, suggesting that we're the right party to come along with the right formulation. There could be a path there. Again, I don't think that would ever be a path to same-game parlays, in-game betting, or micro betting, but that to me seems like the most viable path to someone like a Robinhood in the short to medium term, offering on a national scale something in or adjacent to a sports bet or a sports future prediction.
And just to validate your thoughts here, Lloyd, Blood, the CEO, suggested that Robinhood's entry might resemble its rollout of event contracts ahead of the 2024 presidential election, rather than the traditional sports betting model. So you are right in saying that this is the model that they seem to be pursuing. I mean, just to put some context into Robinhood, it's now a $33 billion market cap. They are obviously absolutely huge. They have 12 million active users in 2023 versus DraftKings 3 million active users. So obviously a massive amount of liquidity and a huge activated user data pool with credit card details, ready to start placing their first bet and so on and so forth. So you would imagine that this demographic is ready to start betting.
When you say all those numbers, what it makes me think of is, what about the reverse scenario? When is DraftKings or FanDuel going to start offering a product that either provides actual or synthetic equity type exposure? And certainly on many of the crypto casino sites, they have, both real, short-term effective, like futures crypto contracts where you can bet, right, will the price of Bitcoin go up or down in the next 5 or 10 seconds, or how much will it go up or down? And you can add synthetic leverage to those bets. You can even do it usually on a totally random number generated, coin or stock that is not even real, but is just completely artificial. So I do think it is worth also thinking about, if Robinhood has all these customers and all this tech, and that people who like that also like to sports bet, might some of the existing operators be trying to think about how can we capitalize on that?
A couple of comments on that. First of all, DraftKings has hinted at exactly that. They've hinted that is something that they're looking at, be it the buying and selling of contracts via prediction markets or other. And to your point, Lloyd, I agree with everything that you're saying. Part of it to me is how we get into the definition of sports betting, because what you're referring to via the buying and selling of contracts approved by the CFTC isn't sports betting, right? It's we can call it what we want. We have to create a new term for it. And that plays into a much bigger topic, which is that sports betting, as we understand it legislated in the US, is but one component of this entire real money gaming movement now in the US, which includes prediction markets, which includes daily fantasy 2.0, which includes sweeps, which includes iGaming and iCasino, which includes all of that, right? So, but to me, when I hear Robin talk about saying we want to go into sports betting, now we have to get into the definition of what they mean by that, and there's different ways that can be interpreted. So I guess time will tell. Certainly, it would be the easier ladder to climb to get into some form of the buying and selling of contracts, as we saw with the elections. But to the point that you make, Lloyd, that becomes a limited product, and it's not as enticing as what the market is headed towards right now on the legislated sports betting side, with in-game wagering, with SGPs and all sorts of other exotic products. And we're only at the tip of the iceberg of what those products will look like in the next 5 years.
It's true. Now, to be fair, Robinhood obviously they already go after the recreational market. So my next comment might not be apropos for them quite the case. But Benjie, you are correct that for the average retail customer, certainly the one that DraftKings is targeting, you need these ultra high margin, long odds, short duration, instant gratification type bets. However, something that a CFTC licensed product would offer, which current typical fixed odds sports bets, and I would argue even exchanges don't, is an apparatus for institutional players who might pay a lower commission or margin, but operate at 10 or 100 or 1,000 times the scale to start participating. If you have a hedge fund that already trades algorithmically in crypto and other derivative products, they might be interested in trading in the sports betting markets. And although some who are ultra sophisticated and place a lot of bets on the Betfair exchange and market make elsewhere, it's not ultra easy today for U.S.-based institutions. One of the other benefits beyond the obvious CFTC approval is an interesting sort of opposite side of the coin that we're discussing. Instant gratification is good for retail, but it's not what institutions want. What institutions want is a product where you can make or lose 10% of your money without making or losing 100% of your money. That is much more attuned to a hedge fund style investing. So, for example, if you imagine a contract, I can buy a contract on Aaron Judge at the beginning of the MLB season. And at the end of the season, let's say it will pay out $1 for every home run that he hits. So at the beginning of the season, if everyone expects that he's going to hit 60 home runs, those contracts will trade for $60. And as the season unfolds and as his expected home run total crystallizes, that price would move up and down. It would never move, I guess in sense of an injury, it would never move from $60 to 0 or to 120 overnight. You'd be looking at a few percentage point gains. And so I do think that while this is probably not what Robinhood is thinking, because that institutional class of clientele is not who they are looking at, there probably is real value in not only offering a CFTC licensed sports prediction product, but one that lends itself more to managing hundreds of millions or billions of dollars of institutional capital, where you're looking for a little bit of a slower burn, a few percentage points each day, rather than, massive binary 100 or 100% plus shifts.
Brilliant and astute analysis of the situation. And talking about disruption here, to move into our second topic, the fact that Robinhood announced that they are considering to move into the sports betting industry came from left field. However, as we are analyzing this move now, it is a move that seems to just make perfect sense in many ways, considering the technology and the database that the company currently has. So that begs the question a bit, what other type of disruptive moves could come into our industry from outside of the industry? We've already seen Fanatics, of course, that entered our industry because of their massive database of sports bettors or sports fans, rather. But what other potential candidates could disrupt the sports betting industry that we aren't thinking about that much today? Lloyd, I want to start on your side. Is this anything that you spend time thinking about when you think about the future of our industry?
We spend a lot of time thinking about it. Part of my job is to find potential acquirers for the businesses that I invest in, and preferably ones that other people aren't thinking about, who aren't constantly getting pitched by similar and competitive businesses. And so I don't want to name anyone specific here beyond groups that we have mentioned on other episodes, other than to say at a high level, one, we're talking about Robinhood here, maybe going to sports betting, maybe going into CFTC licensed sports prediction markets. Certainly, I think, especially when you talk about that latter case, that's a little more institutionally safe and probably doesn't kick up as much dust in board meetings. You would expect any of Robinhood's competitors, and maybe even some of the crypto companies similarly, anyone who has an active user base of people who are risking money on future outcomes related to financial markets, that they certainly would be looking at the similar audience. And then second, and related to what Benjie mentioned about the broader real money gaming ecosystem, there seems to very clearly be an archetype of a customer who likes to risk money on uncertain events on the internet and through their mobile phone. And those could be sport related or election related or politics related or weather or skill-based gaming or whatever it is. It seems not all, but for many, the common thread is that the customers just enjoy that type of experience, and it almost doesn't matter what the medium is, as long as it's the right user interface and it's provided in the right context and in a trustworthy manner and all that. And so I think, and it's something we've said on this podcast and we've said for quite a while, anyone who even roughly touches customers who have an appetite for risking money on uncertain outcomes, and particularly doing it in a digital fashion, I think are absolutely in play as both acquirers and acquirees in this space. I think it only makes more and more sense to consolidate a similar type of customer that you only pay to acquire once and then can cross-sell into many, many areas. So just would encourage people to continue having a wider and wider lens as to what can be considered in the realm of not just betting or real money gaming, but what we sometimes call competitive entertainment, which is all rooted in people caring about outcomes and wanting to engage in entertainment where winning or being right matters in some form.
Brilliant. Astute observation there, Lloyd. And you might have a future as a politician answering this question so brilliantly without answering it at the same time. So I'm going to move over to Benjie here. Benjie, can we be a little bit out there today and actually name some companies, do you think?
Before I even name any companies, and we can take guesses as to who might come in, but my first answer is I think that nobody should be in a hurry to do anything. And what I mean by that, particularly if you're looking at like the bigger companies out there, like the Yahoos, et cetera, that have these massive databases that could potentially, make acquisitions at prices that for them would be a rounding error, right? And particularly if you're looking at some of these bigger conglomerates, I think that they need to play the waiting game for a while longer to better understand how this landscape shakes out on a number of fronts, right? And as I alluded to earlier, what back in 2018 was the launch of some form of state-by-state legislated sports betting is so much more than that 7 years later. We can talk about the sweeps and where that's headed, and the daily fantasy and where that's headed, and the iGaming, which has been really slow to roll out, which has led to the growth of casino sweeps across the country. And what will all this mean as it goes forward, and how will it play out on the legislative front? And what will the existing players in the space do ultimately? I can see a world where some of the existing legislated operators make the leap into some of these quote unquote unregulated areas as they gain comfort as to which states and which do and which states don't allow those particular verticals, right? And I think all that will play into, the bigger roll-up strategy and how other players would view coming into the space. Does coming into the space mean that you're going to be buying and selling contracts for certain companies? Yes. Does coming into the space mean that you're going to do a roll-up of some sweeps and fantasy companies? Or does coming into the space mean that you're just coming in on the legislated sportsbook front with 5 or 7 states that offer casino iGaming, which is currently a duopoly for all intents and purposes? So, I do think that if you look at some of the bigger companies, and I throw out the names such as a Yahoo, that could potentially eventually come into the gaming space in a meaningful way, I think they need to wait to see how things shake out a bit further with Fanatics, and how now that they're beginning Fanatics to pour a bit more fuel on the fire, now that they finally have a product in order and they've made their acquisition and they've got a sports betting team in place that has some expertise, and they're beginning to lean in and elbow in a little bit more on their user base. I think that some of these bigger players want to see how that shakes out, as well as how the legislative front shakes out before they make their decisions.
We'll just add to that point. I think, that originally when a few folks, I think of Bet365 in particular, were slow playing their US rollout, some people in that frantic post-PASPA world were saying, oh my God, they're going to miss out. There's a first mover advantage. You could never get that again. And by the way, first mover advantage is huge in the US, where you legalize sports betting in a new state that has a massive built-in population. And there is significant value in being on there day one. Don't get me wrong. But now that we see the market access costs that Bet365, for example, is able to pay to expand into new states and the much lower customer acquisition cost spending as well, I think some of those decisions from the more patient, more fortified balance sheet holders are starting to look quite smart. And I think Benjie's points about some of the larger folks taking lessons from there are quite apropos. There really is no reason to rush for some of those bigger guys. A lot of them probably have had some of their existing user bases cannibalized to some extent by DraftKings and FanDuel already. So I don't know if there's much risk in that happening to a greater extent than it's already happened, and making sure you understand how's this going to shake out, what different states are going to have iGaming, is there going to be a federal framework that is superimposed on top of all of the state frameworks for sports betting. Certainly worthwhile to have a wait.
Yeah, it's an interesting observation, essentially, that there could be other major media companies and other potential players with big databases that are potentially waiting to see if disruption is possible against the current incumbents in the industry in FanDuel and DraftKings. And as you guys point out, it was Eilers & Krejci that reported recently that the biggest tailwind at the moment is enjoyed by Fanatics, right? To have been gaining market share recently, which is interesting, and we should probably cheer for the smaller players to accrue more market share moving forward. I would say, actually, I'll just kind of throw my hat in there and give a bit of a proposal myself that I'd like the panel's opinion on here. But Lloyd, you pointed out in your argument also that it's not only about which companies have the greatest database and so on, but how is the conversation going to go down in the boardroom? ESG, some companies are more sensitive to ESG than others, but I would throw my hat into the ring and say potentially that X or Twitter could be a prime example of a company that could launch sports betting, partly because of its kind of live in the moment nature that the platform offers, the massive database, of course, but also the fact that it's perhaps not a company that is shy to make controversial move by its owner and founder. And I think the platform itself lends it to integrate itself as a sports betting, certainly a live sports betting platform. So I think if I were to throw out a big prediction here, it would be that X is primed to launch some form of sports betting activity. I would also go back to 2019, actually, and just to bring up a thought experiment with you, Lloyd, an argument that is just interesting to think about, which was Todd Haushalter, the CPO of Evolution, who made a presentation that became somewhat viral. I don't know how viral a clip can go in this industry, but as close as you can get to a viral clip, where he talked about Amazon. What if Amazon would launch Amazon Casino or Amazon Sports Betting? Massive database, an enormous amount of data, and you can be sure that anyone who has ever bought a book related to gambling would be bombarded with offers to join the Amazon Sportsbook, for example. It's just interesting to think about these outside of the box and left field ideas, because it seems to me now, moving through this industry for a couple of years, that disruption rarely happens from where you think it's going to happen. But when it happens, it makes a lot of sense, like we talked about with Robinhood. And another quote, just to close off here as well, is when the same person, Todd, was asked who does he think will be the biggest gambling company in the US in a couple of years, he answered Robinhood. But he didn't answer it because he thought they were actually going to launch a sports betting product, but because he believed that Robinhood was already a gambling company.
Yeah. That argument can be made. It's an interesting point you make, Pierre, is when you talk about X or Twitter. You know, it's been a challenge within the industry for folks to solve the gamut of bringing in the social aspects into real money gaming. And I guess the closest thing we've seen to some success there would be a company like Dabble, which began in Australia with legislated sports betting, and now with Daily Fantasy 2.0 here in the US. One way to solve that gamut would be to take it from the reverse, whereby a Twitter or an Instagram or whatever the social media company may be were to come in on their end and bring all the social features that are firmly ingrained into their culture. So it is an interesting thought process.
I think Amazon did 160 billion in revenue last year. The likelihood that they would expose themselves to regulatory risk and just like the massive operational drain, not to mention a conflict where they are a streaming provider for many of the leagues and then would also be operating sportsbook alongside it, which could get complicated. For them to operate a sportsbook or casino themselves, I would be really shocked. And I would say even similarly for X, which is a smaller company and has more latitude and fewer shareholders to answer to, would I be shocked if X Twitter did an integration with another sportsbook, X real-time betting powered by DraftKings? No, that would not surprise me. But I would be truly shocked if X, which has cut its staff by 90% and is ultra focused on having the fewest number of engineers doing the greatest amount of work, would then expose itself to the massive headcount increase and just bureaucratic process of going through getting licensed for, and operating a sports book, and getting together all the different third-party software vendors that you have to have, and having them all work and talk to each other. I don't think that would mesh at all with X's ultra modern, ultra light, ultra lean, ultra efficient sort of approach to tech. So could Amazon and or X have some sort of really unique, innovative sports betting integration where effectively, from a consumer's perspective, you are betting on sports directly on X or Amazon without ever leaving the app? Sure, I'm open to that. But I would bet, I think, pretty hard against Amazon or X ever being the actual operators, the group setting the odds, the group signing off on whether someone's going to get limited or, their bet is going to go through. I really just can't see those groups ever taking on, that degree of responsibility for the operation.
Time will have to tell, my friends, and I'm looking forward to the next review of the year here when we come into next year and see if we have any movement on this front. Last and final topic of today is we are, of course, drawing to a close here of the year. This is the last vested interest of 2024. I know to our fans that it might seem a bit sad, but of course we will be back early in the next year. So nonetheless, I want to do a quick review of the M&A activity of 2024, partly for your own personal portfolios, but also what's been going on in the industry. So Benjie, perhaps starting on your front, if you were to summarize the 2024 year from an M&A perspective, what are your observations here?
I'll actually kick off on this one just briefly,
Sure.
Only because as we happen to be speaking at this very moment, I don't know when this will actually get published. You guys may have seen there was a nice announcement just a few minutes ago that a company called OddsJam was acquired by gambling.com for up to $160 million. There's a couple of things that are noteworthy about OddsJam. Most importantly, it is, for those who don't know, a betting intelligence product, a suite of tools for sports bettors available at various rates of subscription. And it's quite a premium product and has some really advanced tools. What's notable about OddsJam is that they did not take on venture capital or private equity money. The founders to this day retained ownership of nearly the entire company. And the only outsiders really who were able to find themselves any equity were an incredibly small group of select strategic advisors that they brought on at various points. And I will be happy to tee up Benjie here by saying I think he was maybe the very first or one of the first such advisors, has been along and on the inside for that almost entire ride. So first of all, congratulations on any financial windfall you may have enjoyed today. But more importantly here, Benjie, I think we would all love to know anything you are permitted, to share about your experience with the company, what you saw from inside. I can certainly say Ankit, the founder, is one of those guys who you meet and you say, all right, that's someone who I want to back, no matter what they're doing. And yet, ironically, he didn't need anyone to back him. And he didn't take money from anyone like me who felt that way. And it clearly worked out quite well. And I think in a world where everyone is hungry and chasing venture capital and maybe idolizing or romanticizing what it means to take on investors, this is an amazing example of how sometimes going the other route. So again, Benjie, first and foremost, congratulations. And please, anything you could share would be very welcome.
Yeah, sure. I mean, happy to share some thoughts. I mean, first of all, congratulations to Ankit Goyal and Alex Monahan and to CEO Matt Restivo and Ryan Weinstock, the key pillars of building that business, and what a fantastic job they've done over 4 years and going from zero to where they are today. And a couple of observations that I think are interesting. You allude to the bootstrapping component, and we've said it time again, and I hope some of the up-and-coming entrepreneurs in our space are listening, that whether you actually bootstrap or raise some capital, you're going to be very well served by having a bootstrapped mentality in building your business. And, I look at my year in review, my two biggest exits this year, or probably my two only exits this year, are OddsJam, which is a bootstrapped company, and Zero Flux, which is another bootstrapped company. And these are both companies that really took little to no capital in building their businesses. And I think there's a lesson in there for a number of the upstarts in our space that, you look at the reverse of that and the transaction that was recently announced, DraftKings acquiring SimpleBet, and that certainly wasn't a bootstrapped company. And you look at the results for investors and advisors in one company, the SimpleBet transaction, versus an OddsJam transaction, or to a much lesser extent, a Zero Flux. and it's really a very different situation in terms of the economics, even though one deal might get more headlines than the others. You have to look beneath the headlines and dig in a little bit to the nitty gritty. Another comment that I would make, look, these are, to your point, Lloyd, superstar founders that really dug in and had a vision for what they were doing, and very action oriented in terms of driving product development at a high level. But a couple of things worth noting is that they knew their strengths and they knew their weaknesses. And knowing their weaknesses as founders is, I think, what led to their ultimate success in bringing in from the outside, while they were killing it as a company, and what most objective entrepreneurs would say, wow, these guys were killing it, and they were, but they still went out and brought in from the outside a CEO who was a bit more seasoned, who had skill sets that they didn't have, who was more of the adult in the room, and who was able to formalize and help them professionalize his business. And I think without doing that, they wouldn't have gotten to where they were today. So I think as an entrepreneur, it's important at times to know what you're good at, know what you're not as strong at, put your ego aside, and make decisions that are in the best interest of the growth of your company. And from day one, those are the things that they did, in pursuing certain advisors to partner with them and help them, in pursuing select individuals to join as employees, both at a lower level all the way to the CEO level, right? So, and I think that there's a lesson in there as it pertains to what these guys have accomplished. And look, there's a lot more that I can say about them and their accomplishments. I'll stop there for now, but maybe I will make one more comment, actually, is that, I think that if you're a founder in our space, we talk a lot about, when you're building your company, trying to be really practical with valuations and who you bring on board. Look, for all of you that are in the subscription business, which is primarily what OddsJam is providing, they do B2B as well, but they provide a subscription offering B2C. This is now the North Star, right? And the numbers are publicly available in the documents that were released today on the deal. OddsJam is a company that should finish 2024 in 2 weeks from now, somewhere around 12 million EBITDA, right? And you can see what the price point is in terms of the 80 million upfront and potentially 80 on the back end based on certain milestones that, again, can be sorted out by reading through some of the documentation. But, if you're going out and you're building a business and raising money at 20 million, like this is the North Star right now, right? And you're going to have to show me, even if you're raising at a much lower valuation, what your path is to 12 million EBITDA if you think you're going to sell your business for 100 million bucks, right? So for those that are in the affiliate business and or in the subscription business, I think that this is, we're going to see a lot of decks coming up in the next year that are going to have OddsJam, 160 million on that deck, just as we're going to see decks that are going to have Simplebet 175 million on their deck. But you really need to look beneath the surface and understand what that means. And I think if you're a founder, this is a warning that you need to understand what the TAM limitations are in all likelihood, unless you can break through in a way that these guys haven't, and manage your growth of a company within those constrictions.
Yeah, I think this is actually, if anything, a bearish indicator for affiliate and betting intelligence and subscription-focused startups. It's an incredible bull indicator for founders of the quality of this management team who are inclined to bootstrap. And in this particular case, it just happened to be that their area of obsession was building a product in this space. I don't think this should be a welcoming sign for others to try to replicate or build in the space, or take it as an indicator that the space is hot or anything like that. This was a truly amazing type of management team that you don't come across very often as an investor. And not only were they incredible in all the ways that Benjie described, they had this incredible bootstrap mentality, turning away money. And I think that is what this is a bull case for. One other thing I thought was so insightful that Benjie brought up, and I wanted to add one other point on for those who are not as involved in as many M&A conversations. The Simplebet deal is one that at least we know about because there was enough leverage and enough momentum behind the micro betting product for it still to clear the market and get done. Many M&A conversations start off by saying, okay, what was the last round that the last investors invested at, presuming that in order to get a deal done, it'll have to be north of that valuation. With Simplebet, even with the earnout, they didn't quite hit their Series B post-money valuation. But you could tell from the numbers that roughly where the Simplebet deal was anchored was first based on how much money have they raised. Because if you don't sell the company for more money than you raised, no one except the investors gets back any money. And then when you add in the earnout, that roughly seems to have been anchored by something like where the Series B valuation was. And again, fortunately for them, there was enough power and desire to vertically integrate micro betting that even if, let's say, some of those numbers weren't quite supported by the fundamentals, the deal still got over the line. And that's why we've heard about it. And that's why Benjie could even make the point that you should look deeper at the numbers to understand from a founder's perspective how these different deals went down. What I would submit and suggest to everyone is that for every Simplebet deal, there are 20 deals that actually fail to ever close because there's just not enough momentum or push or leverage to get over that artificial hump of how much liquidation preference do we have stacked up? What was the last evaluation that the last investors came in? When you're in a position that OddsJam was in, none of those concerns ever come up. The nimbleness and the agility that affords you, forgetting about the actual dollar amount of the transaction, the probability of being able to close the transaction without being held hostage by the preferences of other investors or other stakeholders, I think that really cannot be overstated in terms of how valuable that is should you ever find yourself in the fortunate position to be courted by acquirers. You still are going to need a lot to get it done. And I think one of the just absolutely amazing benefits of staying bootstrapped when you can is that agility that it provides to negotiate an M&A transaction, to be quick, and to get a deal done. And I think there are a lot more deals than people realize that never get done simply because early on in the conversation, it is recognized that there are some artificial barriers on valuation that will make the buyer and seller incompatible.
Interesting observations, and I'd also add to that, that the acquirer as well of Odyssey, I mean, Gambling.com Group should also have a lot of credit. It's a publicly traded company, of course, and it's the only affiliate, as far as I'm aware, in 2024 that have actually increased its market cap this year. Gambling.com Group is up something like 60% in the stock market, and they've exploded in the last couple of weeks. And
probably all attributable to their appearance, Charlie's appearance on this podcast. I imagine is the main catalyst.
That's how it went on with Charles Gillespie coming on to vested interest and gaining a lot of investor momentum after that very episode. Exactly. That's very, very right to point out, Lloyd.
Pierre, what a great point you're making here, because for gambling.com, this is a fantastic acquisition, but they've really been to date focused on organic growth and fairly small acquisitions. And they've proven that with the smaller acquisitions, they can seamlessly integrate and make that work within their dynamic. And now they've gone for broke with a much bigger transaction. It's going to be really interesting to see how that dynamic plays out. My intuition is that it will play out very favorably for them, but kudos to Charles and his team, Kevin, Charles, and the rest of the team on what I think is a fantastic acquisition for them. And don't underestimate, they're not just adding all of this revenue and all of this EBITDA to the bottom line. And they've come out and stated they're on a path to 100 million EBITDA. That's the target. They just added 12 and counting. But they've also added human capital and human resource, because the entire management team, including the founders, are coming on board and are motivated to make this thing as big as it can be. So it's going to be exciting times ahead for Charles and company.
That is absolutely true. And just to point out a couple of references here. Better Collective is down something like 50% in the last 12 months. Catena Media, same thing, down 60%. RakeTech down 70%. It's been a tough year for affiliates. Tough year, as reality is coming back in the US market particularly. But on the other hand, then Gambling.com Group up 60% in the same time. Now a $500 million company and a force to be reckoned with. So yes, congratulations to Charles Gillespie and his team for sure. Moving back into the review of 2024, any other notes to be taken here, Benjie, as we summarize the year from an M&A perspective?
I would have thought that they're, heading into this year, that with the market beginning to turn, we might have seen a little bit more in the way of IPO. There really wasn't much, if anything, right? There was I think at the midway point of the year, the announced IPO of Games Global, which they pulled off the table, never came to fruition. There
But we
was
have one now. We have one now in High Roller. It's a smaller IPO.
We have High Roller, which is a smaller IPO, and by all means, it looks like it's off to a good start. I think that'll change in 2025. I know we're not necessarily here to make predictions, but if I were to make one, I think that 2025 will represent the year of the quote-unquote return of the IPO to our spaces as the IPO markets in general begin to gain some momentum.
Yeah, hopefully, again, if as long as interest rates stay under control and volatility, the VIX is at, 13, 14 right now, it does seem like IPO activity will heat up. I think a lot of people are monitoring the performance of the select few IPOs post-launch, and if the IPOs that we are seeing across industries tend to perform well in the few days after going public, that should unlock the IPO underwriting calendar for next year, and then that in turn will vastly unlock, I think, a lot more liquidity, not only into VC and PE deals, but also into M&A. And so, it's tough to predict. There's still geopolitical risk. Inflation might not get tamed. The U.S. actually might have seemed to somehow have done a better job getting inflation under control than some other parts of the world, and that might not always remain the case. So a lot of question marks on the horizon, but it does seem like it's tracking toward a vast improvement in the IPO calendar, which then should trickle through to M&A markets as well as to VC and PE markets.
I have a great feeling going into 2025 myself. I think 2025 is going to be the year. That's what me and my friend Lassen always says. This next year is our year, and I feel the same this time around as well. Lloyd, Benjie, my friends, it's been an absolute honor to go through this year with you guys and to have the pleasure and privilege to record these episodes on a monthly basis. It makes me try to stay up to date as much as I can, and I take in a lot of the information you guys share here. So thank you so much, partners, and I wish you guys Merry Christmas, Happy Holidays, Happy New Year, and we will see you here next year again.
Thanks, Pierre. Thanks, everyone.
Thanks, guys. Happy holidays, everyone.